Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Friday the 18th of July, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, what happens if Donald Trump does fire the Fed chair? But first, Neil Shearing joins me to run through the week in global macro and markets. Hi there, Neil.
Hi, David.
Let's get straight to it. By putting Trump versus Jerome Powell to one side, we've got Stephen Brown, our colleague, in a bit to walk us through that. I would have said that US inflation was the week's big macro news. We had CPI on Tuesday, then PPI on Wednesday. Lots of attention was on this month's releases because of this question of the impact of tariffs. So the dust is settling. What's the big takeaways?
Well, I think the big takeaway is that if you look at the headline numbers, there doesn't seem to be much evidence, does there, of tariffs pushing up prices and inflation in the US. 0.2% month-to-month increase in core CPI in the US in June. The Fed's preferred core PCE deflator perhaps rising a bit more than that. But it doesn't look like this is a kind of great inflationary surge coming from tariffs. But when we spoke about this last week, I said the key thing is to look at the detail of the data. And once you start to do that, you can actually start to see some impact of tariffs coming through. So if you look at the core goods numbers, for example, within the CPI basket in the US, increased by only 0.2% month on month. But that was largely because we saw a big fall in the declines in prices of both new and used vehicles. New vehicles down 0.3% on the month, used vehicles down 0.7% on the month, big component of the core goods part of the CPI basket. So that pulled down the core goods component of CPI. Meanwhile, we saw other tariff-sensitive areas post larger gains. And in fact, if we strip out vehicles from core goods, so we look at core goods X autos, it posted a gain of something like 0.5% month on month. That's the biggest increase we've seen since the kind of dog days of the pandemic, where we had that surge in goods inflation. So dig beneath the surface, and there is some evidence of tariffs coming through. The key question really in the US is, why are we not yet seeing any tariff impact on vehicle prices? And there's potentially a few reasons for those. Retailers in particular delaying decisions to put up prices, waiting to see what the tariff landscape looks like. But in other areas, there is some evidence of tariffs pushing up prices.
Looking ahead, is this just the start of a meaningful tick up in inflation? Then I've spoken before about inventories being worked down. You talked about the front-running effects and warnings from major retailers about having to push up prices. So what is the outlook beyond the June data?
You're exactly right. You can't, on the one hand, see evidence of front-running of tariffs in some of the activity data, and then on the other, be surprised when there's not a huge response to the price data. The two, of course, go hand in hand. The question really, I think, is whether tariff effects on prices have been avoided altogether or simply delayed. And I think the answer is they've probably been delayed. Now, we're not expecting a big surge in inflation in the US, but we do think we'll get a pickup in core inflation, core PCE inflation to back above 3% by the end of, say, Q3. So that's going to leave the Fed in a pretty uncomfortable position. For now, the economy is holding up relatively well. We've had some labour market data over the past week, shows the labour market's doing broadly okay. The retail sales numbers were pretty solid too, but this pickup in inflation, I think, will leave the Fed in two minds as to when to cut. And for now, I still think it's a reasonable assumption that they start to cut a bit later than the markets are assuming.
Notwithstanding pressure from Donald Trump, which we will get into later in the episode. But I wanted to pull back a bit and look at what's happening in the rest of the world on the inflation front, because we have had lots of other releases over this past week. And frankly, some looked a bit too hot for comfort. Is that the broad message there, or are we seeing divergences at play?
No, it's a really mixed picture, actually. We went through that phase in the pandemic, didn't we, where it looked like most advanced economies were following a similar inflation trajectory. Whereas now we're starting to see a bit of divergence. So in Japan, for example, we've just had data for June that's showing that headline inflation edged down thanks in large part to government subsidies, which pushed down energy inflation. But core inflation there In Japan, 3.4% year on year. That's a 17-month high. It's the second highest of any advanced economy, believe it or not. That, I think, in itself would push the BOJ to hike again in October on the basis of the macro and price data. But there's tariff uncertainties, which possible that they might hold off from another hike until next year in Japan. And then in the UK, data, as you say, the inflation data running a bit hot there too. We can get into why that is. But in the Eurozone, actually, inflation ticked up a bit in June. But when we look at the underlying inflation dynamics, they're pointing in the other direction. We've got some reasonable confidence that inflation is coming back down to below target by the end of this year. So different dynamics playing out in different parts of the developed world.
Yeah, why is UK inflation running hotter than Europe's?
Well, it's partly because it seems to be the one area in which the UK leads the world these days is in inflation data, I'm afraid, and for all the wrong reasons. More seriously, I think there's a variety of factors at play here. One, the UK is a more open economy. The pound has obviously strengthened a bit against the dollar over the past few months, but generally has been weak over the past 12, 18 months, and that's feeding through into inflation. Public sector pay settlements have been a bit higher than in other parts of the world. Wage growth generally has been a bit higher relative to productivity growth. That's pushed up inflation. From April as well, this year we had increases in regulated prices, things like telecommunications prices, household utility bills, that they tend to get set on a lag to the rest of the basket. Those increased and have pushed up inflation too in a way that they haven't in the rest of the world. So it's partly to do with a weaker pound. It's partly to do with labour market dynamics and wage settlements. It's partly to do with the way that price setting mechanisms in areas where prices are regulated operate. All of those things have come together that mean that actually when you look at the detail of, I haven't just said you need to look at the detail of the US data, you need to look at the detail of the UK data too. And I think the really troubling thing for the Bank of England will be that just how broad-based the strength of the inflation numbers in June were. So services inflation, which is the key thing they're looking at, stuck at 4.7% year on year in June. The bank had thought it would be falling to kind of 4.6 by now. And that was pretty broad-based across a whole different range of services. So the inflation data is going to concern, I think, policymakers and the Bank of England, the kind of big decision, of course, whether and when to cut rates again. Then later on in the past week, we've had some labour market data showing the labour market in the UK perhaps starting to crack, hiring down. If you look at the payrolls numbers. And of course, all of this is the last data dump that they're going to have before the August the 7th MPC meeting. On balance, we still think it's that they'll opt to cut rates again by another 25 basis points. But I think that the inflation data over the past week just makes us a bit less certain about that call.
And of course, before that Bank of England meeting, there's a load of other big banks making decisions. We've got the Fed and the Bank of Japan last week of the month. But in the coming week, it's the ECB. You mentioned tariff uncertainties and you've spoken about those inflation dynamics in the Eurozone. What can we expect from this coming Thursday's meeting? How does the whole policy debate look from Frankfurt?
I think in terms of what the market should expect, not much, I think, is probably the answer. It's almost certain that they'll keep the deposit rate on hold at 2%. The big question is whether they cut in September or not. And I don't think they're going to give much away on that front. As you say, one source of uncertainty is tariffs. The US and the European Union still locked in tariff discussions. Not entirely clear how that's going to shape up, but media reports over the past few days that there may have been a breakthrough with regards to auto tariffs. Then you've got the question of domestic inflation dynamics in the Eurozone. As I say, headline inflation at 2% in June, core a little bit higher, but we feel reasonably confident in the idea that core inflation is going to be coming down over the coming months. Headline inflation coming down even further, potentially, but there's many on the ECB's governing council that take a different view. And then I mentioned the pound earlier. The euro is another consideration for the ECB. It's been relatively strong over the past few months. And so there's a question as to whether that might push the governing council towards a loosening policy, kind of pushing back a bit against a stronger euro. So on balance, I still think there are reasons to think they will cut again in September. But again, a bit like the Bank of England's cut in August, that's going to be an extremely close call.
ECB board member Isabel Schnabel there was an interview with Econostream Media this past week, and she talks about how she sees tariffs as inflationary over the medium term. for the Eurozone economy because of things like supply chain disruptions and the impact that they have in this fractured world. What do you make of how tariffs affect an economy like the Eurozone?
Well, it's a really interesting point, and there's something to it, but I don't think it's the full story. So essentially, what Schnabel is saying is that tariffs make the supply side of the global economy less efficient, and as a result, you get higher prices, therefore higher inflation. And now, I agree about tariffs, and to the extent that tariffs lead to higher costs and a more fragmented supply side of the global economy, then I think one logical conclusion from that would be that you have higher prices, all other things being equal. However, all other things are not equal. You've got to consider the demand effects too. There can be a dampening of demand as a result of the higher prices that come through and squeezing real incomes that result from tariffs. But also, I think there's a tendency to just view this through the lens of the West. I think we also now need to look at what's happening in China. World's largest exporter, world's biggest manufacturer, and of course, tariffs are a tax on imported goods, not services, goods. So let's look at what's happening in the world's largest manufacturer. And there are extremely vicious price wars breaking out as Chinese manufacturers compete for market share and as Chinese manufacturers attempt to ship production to overseas markets following the surge in investment in China's manufacturing sector over the past 5 years that has built out productive capacity. Domestic demand is weak. They're trying to ship production to overseas markets. As a result, export prices from China have fallen by about 20%. Goods export prices have fallen by about 20 to 25% over the past 3 years. Now, you put a 10%, 20% tariff on that, all you're doing is reversing the cost reduction that you've already seen from Chinese manufacturers. I think all other things being equal, the point that Schnabel's making is a reasonable one. The trouble is that all other things are not equal. So for now, everyone's focused on the potential inflationary effects of tariffs, both directly in the US and then second round effects on global supply chains. But I think over the medium term, by which I mean to say the next 2 to 3 years, the key thing to watch is how events play out in China with regards to these price wars and competition and firms competing for market share in export markets, and then how other governments outside of the US respond and retaliate in the face of that price competition. So everyone's focused on tariffs for now, but my view would be focus on what's happening in China and how governments are responding to that over the next 2 to 3 years.
But that response implicitly then assumes that we're going to be looking at a higher inflation profile for consumers of these Chinese exports, if indeed that response is effective.
If indeed this response is effective, I think that's the point, right? What we've learned over the past couple of months, and indeed the past kind of 5, 6, 7 years, is that the global trading system is extremely flexible and adaptable. So US puts a tariff on China during the first Trump administration, keeps those tariffs on throughout the Biden administration. And actually, what do we see? We see some rerouting of production from China through third-party countries that don't levy tariffs. So supply chains that adapt to some of these regulatory measures. And you'd expect to see something similar could play out if other countries push back against this potential flood of imports from China. If these measures are effective, then yes, the logical consequence of that will be that the prices could go up in the short term. However, the global trading system is extremely flexible and adaptable. And I think the other point to say is that to the extent that countries push back against kind of flood of cheap imports from China, it's extremely unlikely, I think, that means that they will start to encourage production and reshore production domestically. That's as true of Europe as it is of the US. Much more likely that production simply gets shifted to other low-cost centers. So I don't think it's necessarily the case that we're going to see structurally higher rates of inflation over the long term as a result of what's playing out. I think it's perhaps more likely that we see more volatile rates of inflation, so peaks and troughs in inflation rates as we get disruption to the supply side, demand adjusting, and then supply readjusting. So you end up with a more volatile inflation profile over the next, say, decade than we do necessarily a higher inflation profile.
Neil Shearing there on the global inflation picture. Usual caveat, this news cycle is moving very quickly. Neil and I were speaking at 9 o'clock in the morning, London time Friday. That's 4 a.m. DC. Our Europe team's going to be watching that ECB decision on Thursday and responding with rapid analysis and then more in-depth insight as the dust settles that day. I will add their meeting preview, the ECB watch, to the podcast notes. And then the following Thursday, that's the 31st of July. So following on from the Fed's July meeting, we're going to be holding the latest of our regular central bank drop-ins. These are our short-form online briefings that wrap together the latest decisions from the big central banks. And in this upcoming one, the team will be answering your questions about what the latest comms from the ECB and Fed signal about the policy outlook. And they'll be previewing that August 7th Bank of England meeting. I will add a registration link to that event on the podcast notes. We've got lots more drop-ins scheduled in the coming week or two, which you'll want to keep an eye on. I just want to point out a South Africa session, that's this coming Thursday, in which the team is going to explain why we think there could be a big rally happening soon in South Africa's local currency debt. If you're in EMs, you will want to tune into that one. So again, look out for a registration link in the podcast notes. And remember, subscribers to CE Essential and CE Advanced, our all-access packages, get invites to all of these briefings, along with access to all of our written analysis, our data solutions, and much more besides. Now, Donald Trump has been laying into Jerome Powell for months because the president thinks the Fed chair is standing in the way of a much, much lower Fed funds rate. His attacks were stepped up this past week as reports came out that Trump has now drafted a letter firing Powell, and he brandished that letter in a meeting with congressional Republicans. Markets responded quickly and negatively on Wednesday to those reports, and Trump hastily backtracked, saying it's highly unlikely that he's going to fire Powell, quote unquote, unless he has to leave for fraud. What to make of this most intense attack yet by this president on the Fed chair that he nominated in 2017? To find out, I spoke to Deputy Chief North America Economist Stephen Brown on Thursday afternoon London time, and I started by asking how seriously we should take this latest blow-up.
Yeah, I guess there's two definitions of seriously there, but how serious is Trump and how serious could the consequences be? And it seems pretty clear that Trump is serious. This is an idea he's been touting for quite a while now, probably his whole term and before then as well. And he certainly appears to be exploring avenues by which the administration could make this happen. So the latest is this idea that Fed Chair Powell has overseen or mismanaged overseeing renovations to the Fed's headquarters in Washington. So this is a ruse to say that the Fed chair has kind of not done his job properly, and therefore that Trump could fire him for cause in the legal lingo, because Trump can only fire him if there is an actual reason to, rather than just a disagreement about policy.
Because a Supreme Court ruling in May suggested that Trump couldn't just go ahead and sack him, that there needs to be this cause, and so they've ginnied up this cause about overspending.
Yes, exactly. So it's always been the case that we thought that the president had to have a real reason. The Fed chair had to have done something wrong to be fired. The Supreme Court has just confirmed that for us in May. But kind of the uncertainty there is that we still don't know the precise how bad does that cause have to be in order to be a reasonable reason to get rid of the Fed chair. So even if the Trump administration tried to go down this route, the Supreme Court would still have to get involved and say, is mismanagement, number one, has Powell been responsible for this mismanagement, which includes budget overruns? And even if he has, is that reason enough to get rid of him in this context? Trump is serious. Whether the administration and kind of the legal experts in the administration think they have a big enough case to move forward is another question. But then that brings us on to this separate point about how serious could the consequences be in terms of the market reaction if the administration goes down this path. And certainly we got a taste of that this week, because once the news got out that Trump appeared to be getting closer to trying to fire Powell, we saw the dollar plunge by more than 1% in less than an hour. Equities fell quite sharply. And most concerningly, while short-term interest rates fell quite sharply, long-term interest rates moved in the complete opposite direction. And we know from market reaction over other more extreme policies, so back on Liberation Day, when there was movements in the bond markets, that certainly the administration is paying very close attention to them. Scott Bessent in particular is acting as a guide there. So it comes back to this question of, would the administration be willing to accept a further rise in long-term yields in order to get a fall in short-term interest rates? And there could be a case of that. So for instance, if the Treasury was willing to just start rolling over all the debt at the short end, maybe there's some benefits there. But given long rates are already at close to 5% with a 30-year yield at the moment, that's probably not a benchmark they want to cross. It's probably the case that Trump isn't going to move forward with this. He did say it's highly unlikely they're going to try and fire Powell. And I think the market reaction alone is maybe reason to think that it continues to be unlikely. But certainly this is something we need to continue to pay attention to.
So you have that initial violent and violently negative market reaction as these reports started coming out that he's drafted this letter. At the same time, there's this idea that actually if he does replace Powell, if the replacement is considered responsible, sober enough, then maybe the market will just eat the news and get on with it. Does that suggest that actually setting the precedent of firing the Fed chair is just too much for the market to tolerate? In other words, if he were to announce a successor who the market thought of as a steady hand at the tiller, that wouldn't be enough because the precedent has been set.
I think that's the issue here, right? There's plenty of credible candidates out there, but it's obviously very hard to escape the logic that the only reason Trump is potentially doing this is to try and get more representation on the Fed board of people that would be more willing to lower interest rates. So it's clearly an attack on the Fed's independence to some extent, particularly given they have to construct this argument about why Powell has apparently mismanaged these renovations, which obviously isn't really related to monetary policy in any form. So I think it's one where you can make both arguments. I think at the end of the day, the new Fed chair would be just one of 12 voting members. They wouldn't necessarily be able to have a huge influence on policies. They would have a key role in setting the debate, but at the end of the day, they could still be outvoted by the other members of the FOMC. But yes, it is one of these examples where we can construct that logic that there's been plenty of things to concern markets and investors this year. Lots of attacks, not just on the Fed, but other institutions, concerns that this would just inevitably mean that these tariff-induced price hikes would lead to sustained inflation and therefore put upward pressure on inflation expectations, which would push up long-term interest rates. So I think it is quite a dangerous route to go down, certainly.
And he's not talking about he wants a Fed chair who would be willing to trim the Fed funds rate from its current 425, 450 range. I mean, he's talking, 300 basis points? He talked about getting rates down to 1%, right?
Yes, exactly. He has said that. I think we can say that is extremely unlikely, though, because of this point that the Fed chair is just one of 12 voting members. But when we think about the makeup of the FOMC, which is the Fed board consists of the 7 members and then the voting members of the FOMC, which includes some regional presidents who rotate. That's a broader 12 members. So Trump already has 2 appointees if we exclude Powell. So that's Christopher Waller and Michelle Bowman on the board. So he could potentially have another 2 by this time next year because Adriana Kukla's term expires in early 2026 as well. So that would be 4 members of the 7-member board of governors, but only 4 members of the broader 12 members that vote on these decisions. So they're still going to have to set policy sensibly, as it were. So they're not going to cut interest rates by 300 basis points if the economy is doing really well, if the S&P 500 is north of 6,000 and potentially heading to 7,000. But it does increase the likelihood that we get rates cut at a faster pace, obviously, potentially towards the kind of neutral level, which is probably close to 3%. Now, that might not sound like a big deal, but if the economy is doing quite well, say thanks to investment boosts around AI, and if inflation is above target due to tariffs, then the policy rate shouldn't be at that neutral level. It should be slightly tighter. So it does run this risk that it would push up inflation, keep inflation above target for longer, and ultimately risk the Fed losing control of the longer end of the curve and pushing up those long-run interest rates.
So you've got the tariff-induced inflation, and then suddenly you've got still a fairly tight labor market. You've got all these other incipient pressures, and you've got a buoyant stock market. And on top of that, suddenly you're easing policy in that environment. And you're saying that's going to overheat the economy at that point.
Yes, exactly. The whole reason why the Fed is certainly under Powell's cautious about cutting interest rates now is because they don't want a repeat of that pandemic experience where an apparently transitory price shock turned out to obviously be something much more serious than that. And that's what we're trying to avoid this time. Whereas maybe tariffs aren't as big a deal as we thought they were going to be. Certainly, you could make that case based on the evidence so far, but it seems prudent to wait. And part of the reason why tariffs might not end up being as serious is because the Fed does have some credibility, because it's taking this very cautious approach at the moment. If you lose that credibility because you've just fired the Fed chair, then suddenly inflation could quickly become a bit more worrying. And certainly if the economy is doing much better, then there's going to be a lot more scope for businesses to pass on those costs rather than having to take some of the hit.
Assuming Trump doesn't act on his threats, we've got 10 months left of Powell's term. Who are the hot favourites to replace him? And how is that process of replacing the current Fed chair going to work? Just a few weeks ago, the idea was that Powell's replacement would be named well ahead of the end of his term, and that you'd have something of a shadow Fed chair. Is that idea once again current, or is there going to be another mechanism for Trump to be satisfied with who's running the Fed?
Yeah, I think that idea still holds. If anything, you could make the case that is actually what just happened this week, because when Trump was responding to reporters' questions, he did explicitly name-check Kevin Hassett, who's currently the director of the National Economic Council for the Trump administration, as someone that they would consider for the role as Fed chair. So he's certainly been within the list of favourites alongside the other Kevin Warsh and Treasury Secretary Scott Bessent, but that seems like quite a long shot. So Trump has now explicitly named one candidate, so it could be that he's trying to get these names out there as the people that the market should be listening to get a sense of where policy might be heading once the next Fed chair takes over. I do think there's a limit to how much more mileage that the administration can get out of that vote. The market is already pricing in quite a bit in the way of cuts over the next kind of 18 months or so, because we know that Powell's going to be out of the door before long, even if it isn't until the middle of next year. We've already got, say, a terminal policy rate for the Fed funds close to about 3% that I mentioned earlier. It's only if somehow Trump could replace or fired multiple members of the board that maybe we would get expectations for short-term interest rates significantly lower than that, I think. But obviously, in that even more extreme scenario, we'd be talking about long-term interest rates surging even more seriously, given these fears that if the FOMC were to vote to cut the policy rate considerably towards sub 3%, then that really would reignite inflation and push up both long-term inflation expectations and also cause investors to demand a higher term premium to hold that long-term debt, given uncertainty over the inflation outlook.
Stephen Brown there on Trump versus Powell. Since then, Russell Vought, the OMB head, has stepped up criticism of those renovations, and Powell has defended them. Be sure this situation is very far from over, and our US and markets team will be tracking it and bringing you the latest in terms of what it means for the US macro and markets outlook. In the meantime, if you want to speak to Stephen or any member of the team about the risks around this, then please do get in touch. But that's it for this week. We are running a slightly different episode next week, exploring the issue of global economic fracturing in the second Trump administration. And then we'll be back the week after that with a review of that Fed decision and much more besides. Until then, goodbye.